Today we are going to talk about quantifying risk and using that in our investing. Let's start with crude future prices, which is obviously showing very high volatility since the war broke out in Iran. In just 1 week, the price increased about 100%. Then in just 2-3 days, it fell 35%, recently rebounding 25% because the risk of the Strait of Hormuz being closed is arising. This chart is very enticing because if you just get few predictions correct, you can make very high return in short term. However, there is high risk to this high return, so we need to quantify the risk and then use that in our investing activities. In order to discuss this, I will use the crude prices as well as Kospi, which is equivalent to the S&P 500 of South Korea. And because Korea imports a high portion of its energy through that Strait of Hormuz, the Kospi index has shown very high volatility since the war broke out. Although it's an index of the Korean economy, the price is moving up and down like a highly risked tech stock. First, let's look at the simplest way to make money, which is making a future prediction and betting on it. For example, if you believe that the war in Iran will continue for long term, we can expect the oil price to increase at least 50% in short term. And if you believe this, you can invest in the crude futures. However, if you believe in what President Trump is saying, and that the war will end pretty soon, then we can expect the Kospi to rebound, and so we can invest in the Kospi index. The pro of this strategy is that we can make high profit very quickly. However, if our predictions fail, what will happen to the profit? In the first case, instead of the war continuing, if the war ends quickly like what Trump is saying, then the price of crude futures will go down very quickly. Also, in the second scenario, instead of the war ending soon, if it continues for long term, then Kospi can drop another 20% very easily. So in order to manage this risk, we can quantify the risk of losing money if the situation turns out different from our prediction. The first step of doing this is getting the expected return of each asset. As we can see in this Excel file, for the crude price, we start with the $95 per barrel, which is the current price. If the war drags on, as the Iran claims, the price of oil can go up to $200 per barrel, which is more than 100% return in short term. But if the war ends quickly, we can expect the price to go down to the level previous to the war, which is about $60 to $65. We can quickly lose more than 30% of our money. And we can apply the same logic to the Kospi index. And then move on to the second step, which is getting the probability of each scenario panning out. And in this case, for this example, I used that we have 90% conviction that the war will drag on for long term. And since we just have two scenarios, there's 10% chance the war will end quickly. And third thing we need to do is decide how much we're going to invest in each asset. And we can do this by using this portfolio construction section. So for example, I can invest 100% of my money into the crude futures. And then if the war drags on, the portfolio return will be over 100%. But if the war ends quickly, as we saw before, I will lose more than 30% of my money. But here, since we quantify the risk, I can make a portfolio so that even if the war ends quickly, I will not lose money. So I need to lower my investment in the crude to 54 or 53%. Then, if the war ends quickly, I will lose money in the crude, but since Kospi will rebound, I can offset that loss. Of course, in this scenario, I'll make less money if the war drags on and crude price increases. But the key point is that by using this calculated risk and adjusting my investment into each of these assets, I can manage how much money I could lose even in the scenario when I fail to project. And let's discuss 5 key points of quantifying the risk. Here, we moved from the high risk, high return scenario into low risk, medium return scenario by making adjustment to our portfolio. Basically, instead of investing 100% into crude, I invested only 53% and the rest into the Kospi index. But you might ask, what is the actual benefit of making this switch? I'll run some numbers so we can get better feel for the benefit. Here, I'm assuming that this is a high risk scenario, so we could lose 50% of our money. But if we go to the positive scenario, we can make 60%. So there is more upside than the downside. And there is 50% chance of either of these events happening. So now let's start with $1 million and then make 20 bets. So each of the 10 scenarios will make 60%, and another 10 will lose 50%. And as a result, the resulting portfolio will have $107,000 of value, which is about 90% loss. So even though this odd looks pretty reasonable, if we actually run the numbers, if we do not contain the risk, we can lose a lot of money by doing this over and over. Now, instead of doing this, let's say we quantify the risk and make adjustment to our portfolio. So in the risky scenario, we lose only 5%, even though if we make only 15% in the positive scenario. And as before, there's 50-50 chance that either of these happening. And starting with $1 million, if we run 20 trials like before, we'll end up with $2.4 million, which is 140% return. So if we walk through this, 50% probability means we have no idea which scenario will pan out. But because we were able to manage our downside risk, even though our return was lower, we could get pretty decent result in the end. However, if we just focus on the high return, which is up to 60%, and fail to manage the risk of downside, we could lose money like in this case. However, the most mistake people make is they believe they have higher probability of making a correct prediction of the future. So because they're overconfident, they make these risky bets, and they could make money in short term if they get lucky a few times. However, as they do this over and over again, they end up losing money statistically. The second point is that we can use financial engineering to manage this. Instead of lowering the risk like we did before, we could use financial products like inverse, leverage, or options. And this could be reasonable investment vehicles for quant funds or market makers. But because these products can be expensive and sometimes can be very complicated, for retail and long-only investors, the method we saw before, which is managing the risk through portfolio management, can be a better, more reasonable option. Third key point is that we saw various variables here, and each of these numbers have to be somewhat reasonable, even though we don't have to be exactly correct. And even here, you may disagree with the numbers that I laid out. For example, in the worst case scenario, and the war drags on for long term, instead of $200 per barrel, you might want to see the case where the crude price only goes up to $150 per barrel. And you can make these changes yourself through the link below this video. You can download the Excel file yourself and make the changes. Fourth, we can apply this concept to our value investing as well. For example, the Iranian war is the focus of the market today, but just a month ago, the market was focused on the SaaS collapse, which was a hypothetical scenario where AI becomes so much better that it will destroy most of the SaaS models. And this fear resulted in software companies' stock price going down about 30% in just a few months. However, even though the market was worried about the demise of software, it didn't show the corresponding excitement for the LLM models. So if we apply the similar logic that we use today and draw out the scenarios, we could find mispriced opportunities while managing the risk of our portfolio. Fifth is regarding the risk parity strategy. Risk parity strategy invented by Ray Dalio focuses on the macroeconomics, which has inflation and the growth rate as the most important key variables. And upon this, we can diversify our investments into these various assets to manage the risk of the overall portfolio while generating similar return to the market. And regarding this, I am using this concept to manage my dividend portfolio. So if you want to see exactly how I am trading these dividend stocks and bonds, etc., you can check out the link below and join the risk parity dividend strategy. Okay, that's it for today's video, where we quantify the risk of portfolio and then utilize it in our investing. Thanks for tuning in today, and I'll see you guys in the next video.